So to begin with day 2 of the summit, may I please invite on stage our keynote speaker. Please join me in welcoming him with a warm round of applause. Managing Director and India Head, Warburg Pincus, Mr. Vishal Mahadevi.
So thank you for the introduction and good morning to everyone. I know we're a little behind schedule starting, as is usually the case at these summits, but it really is a pleasure to be here today at the Mint India Investment Summit. So for my keynote, I thought I'd spend somewhere between 5 to 10 minutes talking a little bit about the state of the private equity industry and also really how I see some of the key challenges and opportunities in front of us. It's been about 25 years since we at Warburg Pincus made one of the early private equity investments into India. Since those early days of private equity in the mid-1990s, the industry's come a long way. Today, private equity is a well-established asset class in the country. Over the past 3 years, PE firms have invested close to $100 billion into the country, and that represents a substantial portion of the FDI that's come into India. While the industry has matured, I believe the next few years could create one of the most interesting investment environments for private equity that we at Warburg Pincus have seen for the past 2 decades. It's no secret that the current macro is quite challenging here in India. And while there have been several path-breaking reforms over the past few years, there's also been some short-term pain as there have been teething troubles and companies have had to adjust the way they've conducted business. Banks have also been reluctant to lend to businesses due to some of the high-profile bankruptcies that have occurred. And there's been therefore a scarcity of capital in the industry and weak transmission of rate cuts as the central bank has tried to spur things. Both of these have exacerbated the slowdown in growth. Leverage in the system also continues to be high. Many promoters are now worried about elevated debt levels and losing their business potentially in a bankruptcy process. As a result, they're more likely to look to raise equity to pay down debt rather than investing in growth. While all these factors have contributed to the slowdown in GDP that you've seen over the past year, and an economic recovery may take some time to start to crystallize, I think in today's environment, it's even more imperative for private equity firms to be active as they remain one of the sources of long-term capital at scale available to founders and entrepreneurs. Despite me talking all about this current macro slowdown, look, the spirit of entrepreneurship in India still remains as strong as ever. While companies that have historically built businesses based on privileged access to either political capital or bank debt may struggle, this new generation of entrepreneurs that has emerged is taking advantage of a more level playing field, technological disruptions, as well as the reforms that have taken place in the country. Look, companies like Flipkart in e-commerce, Paytm, digital payments, even ICICI Lombard, which was one of our portfolio companies, which 10 years ago was small, they've all become leaders in their sectors and spaces. You know, I believe India's journey to becoming this $5 trillion economy will continue to be driven by this young generation of entrepreneurs, and private equity as a source of patient capital and as a partner to these entrepreneurs will have to play a key role in the economy's growth. Over the next decade, I also believe PE will be instrumental in supporting this next generation of business entrepreneurs in creating business that will not just be champions in India, but can also be global leaders in their respective sectors. PE firms can support entrepreneurs in thinking big, bringing global networks, best practices, while still keeping in mind the importance of being local. In an increasingly interconnected and digital economy, it will become important for companies to look beyond India and to be able to compete on a global stage. In particular, just as some examples, India has a tremendous opportunity to leverage both the reforms and our deep pool of engineering talent to become home to the next wave of innovation in cybersecurity, payments, which I mentioned, and fintech. I think PE will also increasingly serve as a partner to management teams. And this is important, that want to take the entrepreneurial plunge and own a stake in their own businesses. 10 years ago, it was honestly just very hard to convince a strong management team to say, leave your cushy jobs and come start a business or work with private equity and own a stake in your business. I remember personally on my end trying to hire a CFO in one of our businesses, and most people would say, we don't know, will private equity be around? Will this company be around? If we get into trouble, will you support it? I think that's changed today. People have seen success stories. I mean, the story of Alliance Tire, which most of you are familiar with, which was led by Yogesh Mansaria, demonstrated how this partnership can be successful and create a global champion in a sector and space. I think as leaders in the private equity industry, we need to be responsible stewards as well, especially given the important role that the industry is playing in the Indian economy. Entrepreneurship, building businesses, not easy. And we as private equity firms are in a privileged position to be able to partner with management teams, but this is not just through the good times. We need to be supportive partners through even the tough periods that inevitably the economy and India will go through. In addition to our responsibility to partner entrepreneurs and management teams, I think PE firms will increasingly be measured on the broader social and economic impact created by our investments in the country. For us to remain a successful asset class in India, we need to continue demonstrating a positive impact on all stakeholders and job creation. ESG issues, environmental, social, and governance issues, which until recently have largely remained a check-the-box exercise for most global private equity firms, I think will continue to gain prominence. And I'm a big believer that focusing on these will also create more valuable, competitive, and sustainable companies in the long run. So I've saved the key issue for the end of my talk, returns and exits. While private equity will play an important role in India's growth, we will ultimately need to demonstrate a track record of value creation and liquidity for our investors. This is a joint responsibility that falls not only on the private equity funds, but also on the entrepreneurial community in India. And I think founders need to understand and appreciate that for our limited partners to continue allocating meaningful sums of capital to India in the long run, it's critical for private equity managers to demonstrate exits. One way the industry has moved to solve this issue is to focus more on controlled transactions over the past 5 years. However, this is not a complete solution. There is growth capital required. Everything doesn't have to be a controlled transaction, and more is needed to be done in terms of alignment with founders and corporate governance standards to continue building India's reputation with global investors as an attractive destination for private equity capital. While I'm optimistic about the prospects of PE in India, near-term challenges remain. We as an industry need to be more proactive in highlighting the important level that the asset class plays in building businesses, sustaining job creation, and strengthening governance levels. Far too many people in India still view private equity with suspicion and as a short-term capital provider that's solely focused on making a quick buck. The Indian economy and the private equity industry both have got all the right ingredients and tailwinds to continue succeeding. And I do believe the opportunities ahead of us far outweigh the risks. Given the strong hand of cards our industry has been dealt, I'm looking forward to the journey of continuing to support these next generation entrepreneurs as they build world-class businesses that endure the test of time. Thank you.
Thank you, Mr. Mahadevi. We're going to extend this keynote, sir, with your permission, of course, into a fireside chat. So I request you to kindly take your seat as I invite on stage Managing Director, Broad Peak Capital Advisors, Mr. Dinesh Tiwari, to join Mr. Mahadevi in conversation.
Hi, it's my pleasure to host Vishal in this fireside chat. And clearly, Warburg Pincus and Vishal don't need any introduction. I think there's nobody in this room who's not heard of them. But I just thought I'd just put some statistics in perspective, which talk about Warburg, which I thought could actually lead us to take this forward there. Close to about $64 billion of capital. I think one of the oldest investors in India since 94, 95 there. And I think
May not be the wisest, but we are the oldest. It's okay.
yeah, I think we'll leave the judgment on that to the audience and everybody else around there. And very clearly, I think the exits at Bharti Airtel, I think sort of put Indian private equity on the global map there. And having invested in over 1,000 businesses, and Vishal with his long years of experience at Warburg, and being at the helm of the leadership, global leadership at Warburg, I think is best positioned to talk to us today. With that background, I thought maybe it would be good, Vishal, when you said you talked about stewardship and partnership with entrepreneurs there. When you talk to people in the industry, Warburg Pincus emotes a sense of awe, a huge amount of respect. And when you talk to essentially anybody in the ecosystem, and especially investee companies, they have a huge amount of respect there. Especially given what's happening in the environment, and in certain situations where you hear adversarial relationships with management teams and with investee companies. How has Warburg Pincus been able to do this for a long period of time with a variety of businesses, venture businesses, new age businesses, old businesses that is there, and being able to sort of do that? What's the secret sauce? And if you can talk about that, and if there's any lessons for the industry.
Sure. So thanks, Dinesh. Firstly, thank you for the kind words and nice softball question to start this talk. It's always a good thing. I would say, look, as Warburg, and for those of you who know us will know this, for some of you who don't, Warburg's been around for over 50 years right now. And our roots as a firm, by the way, I'm not 50 yet, so just let's be clear, this doesn't come from me, but the roots as a firm really come from venture capital and growth. And what that meant from day one, when the founders of Warburg set up the firm, was our investments were partnering with management teams and partnering with entrepreneurs. And that's what we still do today. And that's the culture and DNA of Warburg. We've never actually done anything else. We don't know how to do anything else, whether it's control or whether it's minority. The mindset and the DNA still remains the same of we're focused on growth, and we're focused on partnering with the right teams up front and focusing with the right founders. And when you have that DNA, so we've never done credit, we've never like raised a public markets fund or done anything like that. We're just growth private equity. Now, this is not just an India thing. So when we came to India in 1996, when we did our first investment, the firm had already been operating for over 30 years with the same DNA and mentality, right? So when we came to India, we didn't have to adapt it for the Indian market. And when you're investing like this, most times you're in minority positions, or even if you're in majority, having worked, you're going to work through good and bad times. Particularly when you're doing what I'll call growth stage investments, because nothing grows in a straight line. Frankly, India is even more jagged than any other place. Maybe there are some others like it. But so that mentality, that DNA, I think just stuck with us. And I give credit to our founders. I give credit to Chip K, who's our CEO globally currently, but he's the guy who started India investing. And I think that culture flows through. I tell you a lesson on why I think it works. It's not that others may also do it. When I joined Warburg, the first day, I remember, one of the guys who hired me said, Vishal, it doesn't matter if you make or lose money on your investments, don't worry. Your job is safe. But if you're ever arrogant to entrepreneurs, if you ever think you're a star and you go out there with advisors, entrepreneurs, and behave in that way, you'll be fired the next day. That was the discussion, that's the culture, that's the way it is. I think that plays a little bit into it.
That's, I think, and that's easier said than done. I mean, a lot of people talk about culture, eating strategy, right? I mean, very clearly difficult, easier said, a lot more difficult to do there. When you look at your investments, it spans across traditional businesses, which has been old age businesses, established businesses and promoters. And you've also sort of transitioned to actually new age businesses and new age promoters, especially the newer e-commerce type businesses and models that you have done. And you sort of seamlessly manage relationships in both. Can you talk about the nuances of basically managing the two different types of partners that you have, which is old traditional businesses, which have been in businesses for generations, and the young entrepreneurs that are just starting businesses? And is there a difference between the two? And how have you been able to seamlessly make this shift?
That's a good question, you know. I think, so firstly, as you see me, Warburg Pincus India, while I have the privilege of heading it here, we have an extremely strong and large team on the ground. So we have some of my partners dedicated to working on what I would call digital new age. You need to have domain and sector expertise to work with that. So I think naturally their inclination of working with a younger entrepreneur and promoter, it's a different type of value add that's required. They need more help in, typically, I should say, with the infrastructure, with the next round of capital raising, with strategy, thinking about unit economics, things were probably discussed yesterday. And that's a big part of the focus. With the older age companies and I'd say more established, it's more about how do you upgrade your management team. You're having different type of discussions. You're thinking more about larger M&A, potentially as a value creator. You're thinking about just being a patient source of capital, the next source of not just equity, but potentially how do you lower cost of capital raising after you come in, whether it's debt or equity. It's a different type of working with them and a different set of issues that they face as they're looking to grow and add value in their businesses versus what's an earlier stage, younger entrepreneur requiring. So it's not as seamless, unfortunately, it's not seamless as you make it out to be, but I think we have folks who are specializing in those different domains, and that helps us keep our head on in the right way.
I think while the differences are there in terms of specializations, but I think what you've done is you've been able to institutionalize the relationship in some shape and form. And more difficult to do as you have a larger team and a larger number of players to actually behave in a similar manner.
Look, it absolutely is. It's a challenge every day. Today we have 30 investments in India, active currently, 30. We have a team of 20 people. I would say my three partners and I have all been at Warburg now for 15 years. This is not something that grows, you know, in 1 year, 2 years, 3 years. So it's not as seamless. I wish I could say it was. We do have some issues that crop up every now and then, but we try to keep our heads straight and working as a team and being able to use each other to basically help cross-pollinate and do this is a massive advantage and help for us.
Great. I think just leading on from that, especially when you start to look at the tech businesses, right, the consumer tech kind of businesses, earlier PE has been thought to be a long-term source of capital. And in the current environment, you find people who have even deeper pockets and a much more longer time horizon. Do you see the way private equity needs to play in these markets to be a bit different than what you play in traditional businesses? Is the time horizons are very different?
Yeah, I think that's a fair point. I think it's not just an India thing. I think if you look globally at private equity as an asset class, the money that has flown into what I'll call consumer tech, new age, digital, has been a different type of capital. Private equity is a very widely used term where you would have hedge funds, strategics, names that everyone's familiar with, some of the large people who would be coming into that market. And I think that market, whether it's Silicon Valley, which is more the VCs, and then in the US goes straight almost to public market funding, or in some case much larger private, you're not finding your traditional large private equity funds being big players in that market. You're not going to hear Blackstone or KKR or Carlyle or some of these folks. That's not a big part of their business. I think that changes, by the way. I think if you're a growth-focused private equity fund like us, we will play. We have played in those. I think we are very much, we are not a top-down investor. The one thing about private equity, and folks know this, we are micro investors. Every investment opportunity is based on that company, that entrepreneur, that risk reward, that pricing, what you think you can do. And honestly, in the consumer tech space in India, and I may be wrong or right on this, we found it a little harder because I think the venture capital firms play a much better role right now. And then they've almost piggybacked straight to a different form of capital, which to your point is that longer form. These things come in cycles and go, but we'll see.
I mean, is it cyclical or is it basically a trend here to see? I mean, you find increasingly mainstream private equity funds getting into the venture space. You find pension funds which are actually jumping into it, which you would never have thought otherwise. So you do you find that's an increasing part of the asset class that to be there in the Indian market?
I think typically it's what's happened in the Indian markets. I'll give you a global perspective. All of these asset classes have come into this consumer tech and digital space globally, whether it's the pension funds, whether it's the large, pick your name, right? SoftBank, Alibaba, Amazon, whoever it is, and Tencent, who are all investing in these companies. I think what we've seen in the US, and even if I pick China, what I see our colleagues doing in China, the companies there are more mature, better formed, profitable already, where you may be debating valuation. That can always be an endless debate. But you're not debating business model. You're not debating profitability. And then you're just, so that's a fair debate to have, and then capital of different sorts is plowing in. In India, and again, some companies have done this, some haven't. I think our consumer tech and digital space is still earlier. And so I will tell you, there's a bit of the cycle out here for us who've been around for a while. Will remember the late 1990s, early 2000s in the US, in the dot-com boom and bust. At that time, you had many of these business models that have not survived very early on. And some great companies got created. Amazon got created at that time, which has gone to where it is today. By the way, for those of you who will remember investing in dot-com in the US at that time, there were probably about 150 other companies I can point to that had big valuations that aren't around today. So I think India is earlier in that stage. You've got more capital coming in because they've been successful in other parts of the world. I think it's here to stay, but there will be a part of the cycle where I think risk reward and private equity investing you will see being more active in this space as well over the next few years. I don't know if that answers your question well.
Sort of. I mean, and if you were to sort of look at the same extension, I mean...
Not to be negative on it, I would just say, like, honestly, for me, I'm seeing unit economics and valuations, and I'm struggling in the space a bit today.
True, and I think very clearly, I think it's a time horizon that you look at it, I guess, which is here.
Yesterday we had I talked about exits, and the time horizon for us, 5 to 7 years. If we're not finding an exit and returning money to our investors, shame on us. Now we've been in companies for longer, but you know that can be 1 out of 10. It can't be 9 out of 10. If it's 9 out of 10, we're not raising our next fund. That's it.
True, absolutely, and I think very clearly, as you sort of, when you talked about exits and returns, and as you sort of look at talking to LPs and global investors, I mean, and you've seen this over the last 15, 20 years, has that narrative changed? I mean, earlier the narrative used to be that exits in India are not there, you don't find too much of exits, is it a great market to invest in? Has that narrative changed?
I wish I could say it has. It's the reason I talked about it in the keynote speech. Look, touch wood, we've had a good experience in India with both investments, exits, our relationships with entrepreneurs, advisors, and the such. I think the industry per se, when I talk to our investors in Warburg Pincus, and I talk about India, there are half of them who frankly don't care. I'll just be honest. They want to know what's happening with China. They want to know what's happening with Brexit. They want to know what's happening in the US election. That's, and rightfully so for them, when they look at their global portfolios, India doesn't fall into the list. The other half who think about India, 90% of them have had one bad experience in India at least, where they say we put money, either it got stolen from us or we lost it, and exits have been tough. Which is why I raised it. I think it's our track record as an industry has improved, because I know that. It's across all our peers, right? We've got some really good stories. But it takes time to erase memories which can stay for a long time with investors. And I think over the next few years, we have that chance. But it's not there yet, as a frank, honest answer to your question.
True. So other than time, is there anything else that can make this narrative change?
Absolutely. We need more exits. We need better stories that we can celebrate. I don't know how provocative I should be when I'm sitting up here on stage in a Mint summit. But you know, look, the government, also the way companies are taxed in India, the way investors are taxed, all of it needs to become a bit more progressive. The reason I say that is, today people don't want to celebrate their success stories. They're worried they'll get a notice. Just genuinely, you want to know what we need success stories. We need the government to celebrate success stories. We need the country, we need the industry to celebrate it. Not because I want to say Warburg made a great investment. I want to say, look, Carlyle made a great investment. Blackstone made a great investment. It's good for all of us as an industry to be able to celebrate that. That's what we need. Please don't print that in any of your Mint papers tomorrow.
No, absolutely. I think it's a difficult call here. Yesterday, just on another topic, just yesterday we were talking a lot about investments in, people talked about investing in businesses that are solving real life problems. And there was this talk about investing in education and healthcare, which is the same extension of the B2C concept that one is looking about. What are your views on that? I mean, how do you see these two sectors where it's a large need, a lot of spend which is in, and are there opportunities in this space?
Yeah, without a doubt, there are. I think you know us well, Dinesh. We have over the past few years, just because we haven't found the right opportunity, we have not invested in India in education or healthcare. We have in the past done it. So let's take them one by one. We've been very successful in education globally. I think the way education is going to be imparted, and you're already seeing this with some terrific names like a Byju's and others in EdTech and other places, which are going to create successful business models and great companies. I think those opportunities will remain. Look, India's regulations do not permit for-profit education in schools and colleges. And while there's multiple people who talk about structures and getting around that and investing, genuinely it's not something we feel comfortable with. We've always been large investors and we've always been very careful about what we've done in the country. However, basically enhancing that education with either, as we talk, tutorials, vocational, just generally providing more tools to children and young adults to basically help them improve the education quality, teacher training. Many of these aspects, I think, need capital, and I'm hoping that we will find more and more opportunities to do that. And that's where tech, frankly, falls right in the middle of it. Healthcare is interesting. Look, big hospitals, we have found hard. Just simply because I think, again, coming back to it's a big capex, long gestation period, the returns on capital have not played out the way you would expect. However, what India needs, I think, in healthcare is not just the big fancy hospital like in the heart of Delhi or Bombay, right? It needs proper healthcare, basic healthcare services to citizens. And there, we are looking, and if there are entrepreneurs with good business models that need capital to scale it, we're looking at it day in and day out. And so I'm hoping we will find some of those to invest more and more in.
I think that's a good message to everybody in the investment banking community, which is then to reach out to you.
Hopefully they're already reaching out. If they're not, I'm a little worried. But
I think we've got a couple of minutes, so why don't we just take a few questions from the audience. I think please state your name and organization and fire away.
Hi, Vishal. You know my name, but Amitabh Malhotra. I'm from HSBC. I had the investment bank. Question to you is that unlike some of our peers who have got regional funds, who've got country-specific fund, you have a global fund. You invest from one fund, everybody eats from that, which means all the decision making has to evolve in the environment that capital is fungible, can be applied in other markets. And how does that equation play out in favor of every time you put up a proposal, other than the fact that on a standalone basis should be interesting? But I thought it would be interesting to know how that would work in your system.
Amitabh, I always expect...
Actually, Vishal, just before you answer that question, there's also been a talk about an India dedicated fund, which is in. So if you can just touch upon.
Sure. So Amitabh knows us well, and that's a really, really good question. And I think, let me answer that one first because it's more topical and critical. At Warburg, the percentage of the fund that is going into India investments right now is 15 to 20% of our global fund is going into India. I am convinced that the next few years will provide the best risk-reward vintage for investing in India. Why do I say this? Look around the world. Liquidity is plenty. I mean, credit is available freely. PE funds have dry powder up the wazoo, I mean, to use a technical term. And genuinely, it's very competitive. India feels, other than consumer tech, which we talked about, feels like a little bit on the opposite end of that spectrum. We need equity. We need capital in the country. Because India has not had this great experience with the LPs, etc., there's not a lot of capital flooding in. So I actually see the risk reward, and what we do when we talk about our investment opportunities globally, and I sit on our global investment committee, you're seeing things across and you are picking things that are the best risk reward globally. And right now, to be very honest with you, we're finding a lot of that in India. That can change, but I actually think that's something over the next few years we are being aggressive, not because we have some great top-down view saying we want to put more into India or anything, the opportunities are there. So I think you'll continue to see some of that happening as we look at our global committee. Look, to answer the second question, yes, there has been some news about it's not an India-specific fund. What we tend to do is a sector that's been good for us, or a country that's been good for us. We've done it in China, we've done it in financial services globally in areas like that. When they become a large part of the global fund, which is a diversified fund, we do raise a separate pool of capital that invests side by side. That's our strategy. But it's still the same investments, same IC, same way we move.
So it's more a side pocket co-investment pool.
I think that's right.
Thank you. I think we've run short of time, which is there. But thanks, Vishal. Thank you very much.